Hello and welcome. It's always a pleasure to have you at the Manifested e-learning platform. Today's lesson, we are going to revise a question that was tested in August 2023. The subject is fixed income investment analysis. Question 4A reads, analyze three approaches used to gauge credit risk of a company. 6 marks. Analyze three approaches used to gauge risk of a company. Now, candidates, there are several approaches that may be used to gauge the credit risk of a company. Hello and welcome. It's always a pleasure to have you at the Manifested e-learning platform. Today's lesson, we are going to revise a question that was tested in August 2023. The subject is fixed income investment analysis. Question 4A reads, analyze three approaches used to gauge credit risk of a company. 6 marks. Analyze three approaches used to gauge risk of a company. Now, candidates, there are several approaches that may be used to gauge the credit risk of a company, and they can broadly be categorized into two: the traditional approaches and the quantitative approaches. We are going to discuss around 5 or 6 of these approaches. The question required candidates to analyze 3. We analyze more than 3, starting with the financial statement analysis. That is the first approach. The analysis of the financial statements can help in gauging the credit risk of a company. And that involves a deep dive into a company's financial statements, including the income statement, the balance sheet, the cash flow statements, and so on. Here, candidates, analysts look at ratios like the profitability ratios, like the one on return on equity, return on assets. Analysts can also analyze the liquidity ratios like the current ratio, the quick ratio. We also have solvency ratios like the debt to equity ratio, and which can help assess the company's financial health. All right. So financial statement analysis is one way to gauge the credit risk of a company. So let's put down the approaches to gauge approaches to gauge the credit risk of a company. One is financial statements analysis of the financial statements. And I've given examples of how these financial statements can be analyzed. That can be done by looking at the ratios, the liquidity ratios, the like the current ratios. We may have the solvency ratios and so on, activity ratios. That's the first approach. The second approach is what we call credit scoring models. We can use credit scoring models. Now, under the credit scoring models, we have the analysts assigning a numerical score to a company based on variety of factors, including the company's financial ratios, the payment history with creditors, the industry trends, and also economic conditions. So a number is assigned to a company based on the factors that I've mentioned, such that higher scores indicate lower credit risk and vice versa. So such models are often used by lenders to automate loan approval decisions. Credit scoring models. That's the second approach to gauge a company's credit risk. Expert judgment, number 3. The credit risk of a company can also be gauged by the judgment of the experts. Expert judgment. The experience and insights of credit analysts are valuable in assessing a company's credit worthiness. They can consider qualitative factors that are not easily captured in numbers, such as the company's management team, the competitive landscape, and also the future growth prospects. So experts can help gauge credit risk of a company by looking at factors that cannot be captured in numbers, like the competitive landscape, the competitive edge of the company, the future growth of the prospects of the company, the management team of the company, and any other quantitative factors. Then number 4, we have, these are the traditional approaches. We have other quantitative approaches, like the probability of default. Probability of default, the PD, probability of default. This is a statistical measure that estimates the likelihood of a company defaulting on its debt obligations, and it's often derived from historical data and complex models that consider various financial and economic factors. Probability, a number is assigned to by considering historical data and complex models. It is a statistical measure that estimates the likelihood of a company defaulting. 5, loss given default. Loss given default. This is a metric that estimates the potential financial loss a lender might incur if a company defaults. It considers factors like the value of any collateral pledged by the company, and also the lender's ability to recover funds through bankruptcy proceedings. Loss given default is an approach that can gauge the company's credit risk. You may also have what we call the exposure at default. Exposure at default. This represents the outstanding amount of debt owed by a company to the lender at the time of default. All right? Exposure at default can be used to gauge a company's credit risk, because it represents the outstanding amount of debt owed by the company to the lender at the time of default. You may also have stress testing as an approach. Stress testing. This involves simulating various economic scenarios, such as recessions, such as interest rate hikes, to assess how a company's creditworthiness might be impacted under stress. You understand? A company is subjected to simulations, for example, by simulating a situation where there is an increase in interest rates. Then the experts check what will be the impact on the company's creditworthiness. The same can be done through simulations on recessions. So stress testing is yet another approach. So these are 7 approaches. 1, financial statements analysis. 2, credit scoring methods or models. 3, expert judgment. 4, probability of default. 5, loss given default. 6, exposure at default. 7, stress testing. This would earn the candidate 6 marks. Any 3 points, 6 marks. That is A. B reads, an investor purchases a 5-year 9% coupon bond that pays interest semi-annually. The price of this bond is 100 shillings and 108 shillings and 32 cents. The yield to maturity for the bond is 7% on bond equivalent basis. The face value of the bond is 100 shillings. Required, determine the following for this bond. Roman 1, total future value of money, 2 marks. Roman 2, capital gain or loss, 1 mark. Roman 3, reinvestment income, 3 marks. Total future value of money. So we read the price of this bond is 108 shillings and 32 cents. That is the present value. So what will be the future value of this amount? That is B Roman 1. We know that future value is always equal to the present value times 1 plus R raised to n. That is the formula, future value. We are to calculate the future value of 108 and 32 cents. So what is the period here? The period n, we read that this is a 5-year bond. So the n here is 5 years. And what is the rate? The rate is the yield to maturity for this bond is 7%. Yield to maturity is 7%. But you also read that the interest is paid semi-annually, and therefore it will be 7% divided by 2, which is equal to 3.5%. So 3.5% will be our discounting rate. 3.5% converted into decimal is equal to 0.035. We raise to, it will be 5 years times 2. Why times 2? Because this interest is paid semi-annually. So we divided this by 2. When it comes to the period, we take 5. That is 5 years. Each year has 2 periods. So we times 2 to get 10. So this n is 10. Then we get the answer. We get the answer there. It's equal to shillings. The future value is shillings 152 and 80 cents. That is the future value of this bond. Then Roman 2, we have to calculate the capital gain or loss. Capital gain or loss. What do you mean by capital gain or loss? Now, candidates for bonds that is held to maturity, there will be a capital loss if the bond is purchased for more than its par value. If the bond is purchased for more than its par value. We read here the value of this bond is 108 shillings and 32 cents. The par value of this bond is 100 shillings, and therefore there is a capital loss because the price is higher than the par value. The value of the bond is purchased for more than its par value. So capital loss is equal to the face value. This is the formula. It's equal to face value of the bond minus the price of the bond, which is equal to 100 shillings minus 108.32, which is equal to negative 8.32. This is a negative, and therefore it is a loss. So the capital loss is 8 shillings and 32 cents. That is part 1, part 2 of that question. So we've answered 1 and 2. That is just a mark. This one is 1 mark, 1 mark. The other one is 2 marks. This one is 2 marks. 2 marks. Then number 3, reinvestment income. We are going to calculate the reinvestment income here. Reinvestment income. Now, what do we mean by reinvestment income? Now, reinvestment income is the interest earned from reinvesting the interim cash flows and the principal payments prior to the final or the stated maturity. The investment income candidates must be generated by reinvesting the semi-annual coupon payments from the time of receipt to the maturity date at the semi-annual yield to maturity. And we calculated here the semi-annual yield to maturity was 3.5%. You understand? Let me take it again. Reinvestment income is income, in our case, that will be generated after reinvesting the coupon payment of 3.5%, because the interest here, the yield to maturity is that the coupon bond is 9%. So the interest here is 9%. The par value of this bond is 100 shillings. That is the par value, is 100 shillings. And we read that the interest is earned semi-annually. Semi-annually. So after every 6 months, the investor earns 9% of 100 divided by 2, because it is semi-annual, which is equal to 4.5 shillings. That is the interest that is earned. But reinvestment income will then be the income that investor receives after reinvesting this interest. So interest, the income that is earned from this interest that will be reinvested, is what we are referring to as the reinvestment income. Reinvestment income is the interest earned from reinvesting the coupon payments prior to the final or stated maturity of 10 periods. Here we have 10 periods, these 10 periods. You understand? So the income that is generated is reinvested. You understand? And that is what you are required to calculate. So it is invested at the end of every period. At the end of every period. So we are going to calculate this interest at the end of every period. At the end of every period, like period 1, we will receive the interest, then reinvest it. Then in period 2 will be received, then it is reinvested. Period 3 will calculate the interest 4.5%, then we reinvest it. So we are going to calculate at every period, then we get the total. That will be the reinvestment income. So we are going to have a column here for the period. Period. We have 10 periods. This 5 times 10. Because it is 5 years, interest is earned semi-annually, and therefore the period will be 5 times 2, which are 10 periods. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 periods. 10 what? 10 periods. Then we'll have here periods reinvested. Periods reinvested. We'll have a column for periods reinvested. So we have the first 6 months. The period 1 is the first 6 months. 6 months. All right. So that interest that will be received after the end of the first 6 months is going to be reinvested for how many periods? It is going to earn this reinvestment income for how many periods? That will be 9 periods. The end of the first year will be reinvested for a period for 8 periods. Will be invested for 8 periods. The interest that will be received at the end of the third period, that is after 1.5 years, will be invested for 7 periods. The one that will be received at the end of the fourth period will be invested for 6 periods. So it goes down like that: 5, 4, 3, 2, 1, and 0. Now the interest that will be received at the end, that is at the maturity, at the end of the 5th year, which is at the end of the 10th period, that interest will not be reinvested because the bond will be retired after 5 years. So that's why we have 0. Then we are going to have the reinvested income. The reinvested will have a column for the reinvested income. And we've already calculated the interest, which is uniform. The interest is uniform. It's 4.5. How did I get 4.5? It is the annual 9% divide by 2 to get the semi-annual rate times the par value 100 to earn 4.5. That is the interest that will be earned at the end of every period, which it will then be reinvested. So this 4.5 will be reinvested. So we are going to calculate at every period. This 4.5 is going to be reinvested, and we need to calculate or determine the amount of the reinvestment income. Reinvested income. Reinvestment income. This is reinvestment. Reinvestment, not reinvested, but reinvestment. Income will be equal to 1.5 into 1 plus R. All right, that will be 1 plus R. Our R is 3.5%, and therefore 1 plus R will be 1.035 raised to 10 periods minus the time minus 4.5 to use to calculate the investment income after the end of every period. So for example here, at the end of period 1, we'll have 4.5 into 1.035 raised to 9. This 9, which is 10 minus 1, gives us 9. Then the amount we get here, we deduct 4.5. 4.5 we have to deduct 4.5 to get the reinvestment income. Now, why are we deducting 4.5? We're deducting 4.5 because after compounding this interest is compounded. We compound 4.5, 1.035 raised to 9. This one is compounded. When you compound, this is what we get. This, when compounded, we have 6.133. This 6.133 combines the principal plus the interest. This principal is this 4.5, which was reinvested. So the 6.133 combines both the interest and the principal. This is equal to 6.133. And therefore, the interest that is earned on this 4.5 will be equal to this 6.133 minus 4.5 minus this 4.5. That's why we are deducting this 4.5 from this total of the principal and the interest. So 6.133 minus 4.5 is now the reinvestment income that is earned after reinvesting 4.45. That will be equal to 1.633. 1.633. You understand? We'll use the same approach. Period 2 will have 4.5, 1.035 raised to 8 minus 4.5. The other one will have 4.5, 1.035 raised to 7 minus 4.5. Period 6 will have 4.5 into 1.035 raised to 6 minus 4.5. Period 5 will have 4.5 into 1.035 raised to 5 minus 4.5. Period 4, 4.5 into 1.035 raised to 4 minus 4.5. Period 3, 4.5 into 1.035 raised to 3 minus 4.5. Period 2, we have 4.5, 1.035 raised to 2 minus 4.5. Period 1, 4.5 into 1.035 raised to 1 minus 4.5. Then the last period we have 4.5 into 1.035 raised to 0 minus 4.5. 4.5. So we need to calculate all these values. Then we get the total. That will be the reinvestment income. It's now the work of the calculator. 1.426 1.225 period 6 1.032 0.489. Next, second period. This one we don't need to calculate because any number raised to 0 is 1. So 1 times 4.5 minus 4.5, this is equal to 0.00, meaning that there was no income, investment income, at the end of the maturity period. So you're now going to add this total to have the total investment income. These are investment incomes for each and every cash flow. Then we get the total investment income. So the total investment income is 7.79. 7.79. Let's move on to, we are answering August 2023, question 4, that is fixed income investment analysis. Question 4C reads, the following treasury spot rate curve is provided. We have a column for period, year, cash flow, and spot rate. These are 4 periods. Below the table, I read, a 10% 2-year treasury bond is issued in the market based on the 2-year treasury yield of 6%. The par value of the bond is 100 shillings. Required Roman 1. The arbitrage-free value of the bond, 3 marks. Roman 2. The value of the bond using the traditional valuation approach, 3 marks. Roman 3. The arbitrage profit, 2 marks. But first of all, this investment income is how many marks? 3 marks. All this was to earn the candidate 3 marks. 1, 2, 3, 4, 7, 8, 9, 10. All these candidates was to earn just 3 marks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All these we worked out. The marks are added here. 3 marks. Then part C, Roman 1, the arbitrage-free value of the bond. Arbitrage-free value of the bond. C1. The arbitrage-free value of the bond refers to its theoretical fair market price based on the present value of its expected future cash flows discounted using an appropriate interest rate. So that's the meaning of the arbitrage-free value of a bond. It is the market price based on the present values of its expected future cash flows. So from that definition, you can get the formula. We will easily compute the present value of the expected future cash flows. The present value of the expected future cash flows will be the arbitrage-free value of the bond. And we read from this question that after the end of period 1, the expected cash flow is 6%. 6 shillings. Year 2, 6 shillings. Year 3, 6 shillings. Then period 4, we have 106 shillings. Below the table, we read a 10% 2-year treasury bond is issued in the market based on the 2-year treasury yield of 6%. Yield of 6%. The par value of the bond is 100 shillings. The par value of the bond is 100 shillings. And you can see, candidates, the yield, the coupon is 10%. 10%. The yield is 10%. All right? The yield is 10%. The par value is 100 shillings. And therefore, the cash flow here will be 10% of 100 shillings. Then we divide by 2 because it is semi-annual. All right? It is semi-annual. annual. A 10 two-year treasury bond is issued in the market on a 2-year treasury yield of 6%. The par value of the bond is 100 shillings. So first of all, let us put down the formula. The arbitrage free value of the bond, abbreviated as P, present value, will be equal to the coupon amount, C, over 1 plus S1, where S1 is the spot rate period 1. The spot rate period 1, we add C over 1 plus S1, this is raised to 2, this should be raised to 1, plus C over 1 plus S3, this should be S2, spot rate 3 raised to 3, plus C. Now the fourth period, we are going to add the par value of 100. So it will be C plus 100 shillings over 1 plus 4 raised to 4. The denominator is the discounting factor. The denominator is the discounting factor. The denominator is the discounting factor. This C is the coupon amount. C is the coupon amount. Is the coupon amount which I have said is equal to 10% times 100 divided by 2. So this is just 5% times 100 shillings, which is equal to 5 shillings. Now that we've divided these, the spot rates provided in the question, the spot rate for period 1, we can see there is 4.8%. So the spot rate we are going to use here will be 4% divided by 2. For the second period, it will be 5% divided by 2. So this will be equal to 5 over 4% divided by 2 is equal to 2.4. 2.4% converted into decimal is equal to 0.024. So this is 1 plus 0.024, which is equal to 1.024 raised to 1, plus 5 is constant over 1 point. The second period spot rate is 5%, divided by 2 is 2.5%. So this is equal to 0.025 raised to 2, plus 5 over 1 point. The third period interest rate is 5.2. 5.2 divided by 2 is equal to 2.6%. Converted into decimal is equal to 0.026. So it's going to be 0.026 raised to 3, plus the fourth period will have 5 plus 100 over 1 point. The spot rate for year period 4 is 5.4%. 5.4% divided by 2 is 2.7%. So it will be 0.027. The rest is the work of the machine. Right? The rest here is going to be the work of the machine. So this is raised to 4 raised to 4 raised to 1, 2, 3, 4. So the rest is the work of the machine. So I'm going to punch in all this, then we get the answer. Do you understand? That will give us the arbitrage-free value of the bond. The arbitrage-free value of the bond is equal to shillings 108.66. This is the arbitrage-free value of the bond. That is Roman 1. Roman 2, we are required to calculate the value of the bond using the traditional valuation approach. Now, the value of the bond using the traditional valuation approach, we are going to discount the coupon amount, which is an annuity, using a present value annuity factor. Then we discount the par value, which is a lump sum, using a present value interest factor. All right, you understand? So this will be equal to the coupon amount, which is just 5 shillings. We are going to multiply this coupon amount, we discount it, which is an annuity, with the present value annuity factor, R. Now our R candidates, we see from the question that this is a 10% 2-year treasury bond, and the yield is 6%. The yield is 6%. So it's going to be 6% divided by 2. So the R will be 3%. 3%, and it is a 2-year treasury yield, 2-year treasury yield times 2. That is going to give us the period. 2 times 2 is 4. So we are going to have this present value annuity factor times the coupon amount. Then we add the par value, which is 100 shillings, the par value times the present value interest factor, R, 3%, N. So these two, that is what we are going to do. That is the traditional valuation approach. The traditional valuation approach. So the coupon amount is 5. We multiply by this factor. This factor, we get it by this formula, 1 minus 1 over 1 plus R, which is 3%. Converted into decimal, it will be 1.03 raised to N, which is 4 over R, 3% into decimal, 0.03, plus the par value is 100 shillings times 1 over 1.03 raised to 4. The rest is the work of the machine. The rest is the work of the machine. So from here, we will use a calculator to get the value of this bond using the traditional valuation approach. This is equal to shillings 107.43. That is the value of the bond. Roman 2. Roman 3, we are to calculate the arbitrage profit. The arbitrage profit. How do we calculate the arbitrage profit? Now, to calculate the arbitrage profit, we are going to deduct the value of the bond, this value of the bond, from the arbitrage free value of the bond. So this will be equal to the arbitrage free value of the bond, arbitrage free value of the bond minus the value of the bond. The arbitrage free value of the bond minus the value of the bond, which is equal to 108.66 minus 107.43. So that is the arbitrage profit. The arbitrage profit is 1 shilling and 23 cents. This is the arbitrage profit. How many marks? Arbitrage profit, 2 marks. 2 marks. Now, candidates, the arbitrage profit refers to the profit made by exploiting the price difference of the same or similar asset in different markets. It is the profit that is made by exploiting price differences, and it capitalizes on temporary market inefficiencies where an asset is priced inconsistently across the markets. That is the arbitrage profit, and in this case it is just 1 shilling and 23 cents. Roman 2, you are calculating the value of the bond using the traditional valuation method, 3 marks. 1, 2, 3 marks. Here, arbitrage free value of the bond, 3 marks. Formula, working, 3 marks. So we worked out August 2023 question 4, fixed income investment analysis that was done by the CIFA candidates. Thank you for attending the lesson. Make sure you go through the video one more time. Then you can check from our books, revision books. Let me show you a sample of the book. Make sure you get this book, because within this book we have identified and arranged the questions topically so that you can revise topically. You can, after going through this one, look for a similar question from the past papers. They are well arranged in this book. You don't need to figure out which questions appear under this topic. You can find them arranged in this book, attempt the questions. The answers are shown at the back of the book. Make sure you refer to the answers, mark your work. In case you still may have any question to ask after going through the questions and the answers provided in this book, please write to us. Our WhatsApp numbers are open. We will help you revise fixed income investment analysis paper. Thank you. God bless you. Bye-bye. Greetings everyone, and welcome back to the lesson. The subject is fixed income investment analysis. We are back at it again to solve the questions that were tested in August 2023. We are committed to ensuring that all the past paper questions that are examined by Kasneb for the CIFA advanced level are done We are moving on sitting by sitting. Today we answer question number 1 from the August 2023 paper. Question 1 is in 3 parts, A, B, and C. Part A reads, in relation to currency denomination, explain the following types of bonds. 1, dual currency bonds, 2 marks. 2, currency option bonds, 2 marks. That is the question. In relation to currency denomination, explain dual currency bonds. Dual currency candidates are bonds which are also known as multi-currency bonds or currency option bonds. These bonds are bonds that are bonds where the coupon payments and or the repayment, principal repayments, are denominated in one currency but are paid in another currency at a predetermined exchange rate. Do you understand? Dual currency bonds are bonds where the coupon payment and the principal repayment are denominated in one currency, but the payments are done in another currency. And in a dual currency bond, investors receive payments and the principal amount in a currency other than the one which the bond was issued. Do you understand? The exchange rate at which the payments are converted is predetermined in advance. It's determined in advance, or it's predetermined. The exchange rate is predetermined. And the two currencies that are involved in a dual currency bond are typically chosen based on the issuers and the investors' preferences. You understand? For example, a Kenyan company might issue a dual currency bond denominated in Kenya shillings, but offering coupon payments and the principal repayments in Uganda shillings or US dollars at a fixed exchange rate. And that allows the issuer to assess the foreign currency market while still paying back investors in their preferred currency. That is a dual currency bond. Then the currency options bond, on the other hand, currency options bonds are bonds that give the bondholder the right but not the obligation to convert the bond's principal or interest payments from one currency to another. And that is done at a predetermined exchange rate on a specific date or within specified period of time. You understand? That is a currency options bonds. Are bonds, I repeat, that give the bondholder the right but not the obligation to convert the bond's principal and the interest payments from one currency to another at a predetermined exchange rate on a specific date. Do you understand? And the bondholder can choose whether or not to exercise the currency option based on prevailing exchange rates and based on market conditions. So those are the bonds, types of bonds in relation to currency denomination, the dual currency bond, and the currency options bond. I've explained the dual currency bonds. I've said that these are bonds that are where coupon payments and principal are denominated in one currency but are paid in another. Say that they are issued in one currency but paid in another. The coupon payments and principal. Coupon payments, this is the interest. Coupon payment is the interest on the bond. Coupon payments and principal are issued in one currency but paid in another currency at a predetermined exchange rate. That is dual currency bond. Number 2, we have the currency options bond. Currency options bonds. I've said that these are bonds that give the bondholder the right but not the obligation. These bonds give the holder the right but not the obligation to do what? To convert the bond's principal, but not the obligation to convert the bonds principal and interest payment from one currency to another. The bonds principal and interest from one currency to another. The bondholder has the right but not the obligation. It's not obligated to convert the bond principal or interest from one currency to another. That's the meaning of the dual currency bonds and the currency options bonds. Then part B, describe 3 factors that might affect floater's price. Factors that might affect floater's price. Now, floaters are also known as floating rate bonds. These are floating rate bonds. Are bonds whose interest rates are not fixed but adjust periodically according to the specified benchmark interest rates, such as the LIBOR or government bond yield. So there are several factors that may affect the floating rate, the floating rate or the floater's price. All right, floating rate bonds. There are various factors that may affect the floating rate bonds. One obvious factor is the benchmark interest rate. I've just defined a floating rate bond as bonds whose interest rates are not fixed but adjust periodically according to a specified benchmark interest rate. So if this benchmark interest rate changes, then the floater's price is automatically going to change. If the benchmark rates rise, the coupon payments on floaters increases, making them more attractive to investors and potentially increasing their price. Conversely, if the benchmark rates fall, the coupon payments decrease, which may reduce the attractiveness of the floaters and also lower their price. So benchmark interest rate is a factor that affects the floater's price. Credit risk, number 2. The second factor is credit risk. the creditworthiness of the issuer can affect the price of floaters. If there are concerns about the issuer's ability to repay the principal or make interest payments, then investors may demand higher yields, leading to a decrease in the price of the floaters. Number 3, market sentiment. Market sentiment. This is a sentiment of the investors. Investor sentiment and the overall market conditions can influence the demand for floaters, whereby positive sentiment and favorable market conditions may increase the demand for floating rate bonds, driving up their prices. On the other hand, negative sentiment or adverse market conditions may reduce demand and then lower the prices of floaters. So market sentiment, the investor sentiment is a factor that affects the floaters price. 4, liquidity is yet another factor. The liquidity of floaters can impact their price. Where more liquid floaters are easier to buy and sell, typically commanding higher prices than less liquid ones. If a floater becomes less liquid due to changes in market conditions or due to issuer-specific factors, its price may or is likely to decline. Liquidity. 5, supply and demand dynamics. Supply and demand dynamics. Supply and demand dynamics. Changes in supply and demand for floaters in the market can affect their prices. Increased demand relative to supply can drive up prices, while excess supply can lead to lower prices, floaters prices. The normal dynamics or forces of supply and demand. So these are 5 factors. Candidates were to give just 3. 1, benchmark interest rate, credit risk, market sentiment, liquidity, supply and demand dynamics. 6 marks. Part A of the question, we explained dual currency bonds and currency options bonds. These were to earn a total of 4 marks. So candidates, you can see these are easy 10 theory marks. We move on to part C. Tausi Limited issued a term bond with the face value of 1,000 shillings. The yield to maturity of the bond is 10% and it has a coupon rate of 12% per annum. The bond coupon will be paid annually. The bond term to maturity is 4 years. Required, Roman 1. The price of the bond, 3 marks. Roman 2. Macaulay duration, 2 marks. Roman 3. The modified duration, 2 marks. Number 4. The bond convexity. This is August 2023 question 1C. We are given details regarding a term bond with the face value of 1,000 shillings. So what is the price of the bond? We all know by now, candidates, that the price of the bond is the present value of the principal amount and the coupon amount. The principal amount, which is the face value, we are going to discount the face value of 1,000, and then we discount these interest payments at 12%. The bond is 10% and it has a coupon rate of 12%. The bond will be paid annually. The bond coupon will be paid annually. So that is the period, yearly. The bond term to maturity is 4 years. 4 years. So we are going to, if you are to calculate the price of this bond, the price of the bond will be equal to the present value of the par value plus the present value of coupon payments. And this one is a lump sum. The par value is paid once. It's a lump sum. The coupon payments, these are annuities. So we are going to use different present value factors. This will be present value interest factor Rn. We multiply with the 1000, the face value, plus present value annuity factor Rn times the annuity of 120. Is it 120? Yes, 120. How did I get 120? I took the coupon rate of 12% times 1,000. 12% times 1,000 is equal to 120. This will be equal to, this factor will be 1,000 times 1 over 1 plus r, 1 plus r, 1 plus r, plus the factor here is 1 minus 1 over 1 plus r raised to n over r. That will give us the factor times 120. You understand? So the R will be the 10%, the yield to maturity, the 10%. So this will be equal to 1,000 times 1 over 1.1 raised to, this will be raised to n raised to 4. That is the period. From the question we read, the bond term to maturity is 4 years. So this you are going to add here, 1 minus 1 over 1.1 raised to 4 raised to 4 times 120. So this is going to be the price of the bond. I'll take my machine. So the rest is the work of the machine. We discount this, we discount that, then we add. And this is over R here. This should be 0.1. 10% into decimal, 0.1. So the rest is the work of the machine. So that is the value of the bond. The price of the bond is 1,000 shillings and 63. 1,000 shillings, 1,063, 397 cents. This is Roman 1, Roman 1, C Roman 1, C Roman 2. You have to calculate the Macaulay duration. Now, candidates Macaulay duration is a concept that is used in fixed income investing to measure the average time it takes to receive all the cash flows, both the principal and the coupon payments from a bond, which is weighted by their present value. In simple terms, it tells you how long you should expect to hold the bond on average to get your money back from to get the money that you invested back plus the interest. And Macaulay is named after Frederick Macaulay, who was an economist who introduced the concept around 1938. So by that definition, candidates, you can tell the formula. I've said that Macaulay duration is a measure that helps us determine the average time it takes to receive all the cash flows from a bond. And the cash flows include the principal and the coupon payments. And we use a weighted present value, which means you are going to have the present values, then we compute their weights, then we'll multiply the weights with the period to determine the Macaulay duration. So that is the formula. We're going to have here period, and we know there are 4 periods. These are 4 years. Period is 1, 2, 3. The next column is the cash flows. We know the cash flows include the principal of 1,000, which is the par value of the bond, and the coupon payments of 120 shillings per annum. That is the cash flows. We'll have another column for the present values, PV. So we'll have the periods. Let me put them down. 1, 2, 3, 4. The cash flows at the end of year 1 is 120, 120, 120. The bond term to maturity is 4 years. All right, it is 4 years, which means in the 4th year we are going to have the 120 plus the principal, the 1,000 plus the principal, which will be equal to 1120. That will be the cash flow. Do you understand? So you're going to have the present values of these cash flows under that column. That is the present value. Then we'll use these present values to calculate the weights. You're going to have a column for the weights. Then lastly, we will multiply the weights. We will multiply the period times weight. These are the periods. So that is the formula, candidates. That is the formula for calculating Macaulay duration. So let's work out the present values. This is 120 shillings per annum. We are going to discount this 20 as a lump sum. At the end of year 1, we discount the 120 at 10%. So you're going to have 120 divide, we open a bracket, 1.1, close the bracket, raised to 1. So when you discount this 120, I'm getting here 109, 109,090, 109.090. Second year is 99.174. Next, raised to 3 years, 90.157. Next, I have the 1120, 764.9. This is 975. 764.975. So you get the total here to allow us have the weights. So I'm going to add these present values. 106, 3.40. That is total present values. Then we get the weights. How do we calculate the weights? We're going to take at each period, we divide by the total, then we'll have the weights right over there. So firstly, year 1, we have 109. This 109.090 divided by 1063.4. 0.103. Next, I'll take 99.174. 0.093. Next is 90.157 divided by the total. 0.085. Then lastly, I have this is 0.719. Yes. So this should give us 1.0. Those are the weights. So the last column will take the weights times the period. The first one is 1 period. The first period we take 1 times 0.103 is equal to 0.103. Next, we are going to multiply 2 by 0.093. 0.186. Next, we'll have 0.085 times 3, 0.255. Then lastly, I'll take 0.719. This gives me 2.876. After that, we'll add this product of period and weight to get the Macaulay duration. So I'm going to add, so the answer here is 3.42. 3.42 is the answer. 3.42 is the answer, is the Macaulay duration. 3.42. That is the answer. So how many marks? These are just 2 marks. Can you imagine? Just 2 marks because it is simple. This is simple. 2 marks. Remember I said Macaulay duration is a concept that is used in fixed income investing to measure the average time it takes to receive all the cash flows, both the principal and the coupon payments from a bond. So it is going to take 3.42 years. So candidates, that is Roman 2. Then Roman 3, modified duration. We want to calculate the modified duration. Modified duration. Now here, what is being modified? Here, candidates, is a refinement or a more precise measurement. The modified duration is a more precise measurement of the bond's price sensitivity to changes in interest rates compared to the maculae duration. It is this maculae duration that is being modified here, what we are calling modified duration. It addresses some of the limitations of the maculae duration by incorporating the bond's current yield to maturity. That is to say that modified duration is determined by dividing the maculae duration to modify this maculae duration. We're going to divide by the maculae duration by incorporating the bond's current yield to maturity, which is equal to 1 plus the yield, then we divide by K, where K is the number of periods per year. In our case, the periods are 4. And the yield is the yield to maturity of the bond. The yield to maturity of the bond, we read from the question, the yield to maturity of the bond is 10%. And therefore, the modified duration will be equal to the 3.42, which we calculated in Roman 1 plus the yield. The yield is 10%, which is 0.1 divided by 4. K is the number of periods. The number of periods. So this is going to give us the modified duration. Modified duration, which is equal to 3.34. The modified duration there is 3.34. 3.34. Now, part 4 of the question is about, this is Roman 2, Roman 3, then Roman 4. We have the bond convexity. Now, a bond convexity is a measure of the sensitivity of a bond's duration to changes in interest rates. And bond convexity provides additional insight into how a bond's price will change in response to interest rate movements beyond what is captured by the modified duration. So this is a more refined measure compared to the modified duration, which is a modification of the maculae duration. So let's compute the bond convexity of this bond. We are given the period. This is how to compute. Going to have periods on the first column. Then we'll have the weights, which we have already calculated. The weights we calculate convexity here. Convexity. We'll calculate the convexity, the last column. And convexity will be calculated at, first of all, at each and every period. Then we'll sum the convexities to get the bond convexity. And here is the formula for convexity. We're going to take the period into 1 plus period times weight. So we'll have period into 1 plus the period times weight. We divide by 1 plus yield to maturity squared. That is the formula for convexity. We're going to first of all have period 1 here. The weight for period 1 is 0.103. 0.103. So convexity period 1 will be the period which is 1 into 1 plus period 1